Yeah, let's pull up the chat here. You can drop a comment when you're tuning in. We'll wait just a few minutes to get started here. Go ahead and drop a comment in there as you pop in. Good morning, good morning. Hope everyone's been having a good week so far. Interested to see what the rates are looking like today, of course. With all this volatility in the last few days, the last week, I guess we should say. All right. Good morning to everyone in the chat. All right. So we can go ahead and take the chat off. Looks like we are live everywhere, so we can go ahead and get started here. All right, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. One of these non-QM loans that we like to do is an asset utilization loan, a couple different names for it and a couple different ways that we can approach it as well. So what we're going to do today is Jose is going to go into a deep dive on these loans and pull up a couple actual scenarios here that we can look at with different quotes. But before we do that, like we do every day, we're going to go through the actual live rates for all of the different programs here today. So with that being said, Nick, why don't you go ahead and pull up our pricing tool so we can go over the actual rates live today.
All right, thank you, sir. So let me go ahead and switch up my screen here, and we will get into the pricing. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. We got over 300 loan officers in pretty much every state, and we can do primary and second home loans in 22 states across the U.S. and our business purpose DSCR loans in pretty much every state. So a lot of great options there. If you'd like a full loan estimate with a full breakdown, please get with our team. But we're going to use our pricer today to check out the general indications for the pricing, including some APR stats, and it is March 22nd, just after 11 a.m. Eastern. So all of our programs are live. Today is a big day for the markets. We have the Fed announcement coming later. Obviously, tons of news and chatter about what is going to be the announcement. So these rates today, this morning, are going to be obviously pre-announcement. We should probably do the show again later today, post-announcement. But let's see what the live rates are this morning. Definitely recommend everybody checks it out again after we all hear the news. But let me get into the pricer here. So we're going to set up some simple scenarios and go through them. We're going to set a nice easy loan amount of $400,000. We're going to set an LTV here of 80% loan to value. That means 20% down payment. We're going to set a desired price of 99. That means the computer is going to find the best rate for one discount point in buy down. Most of our customers are buying down the rate a little bit. So that's our typical scenario. We are going to compare our conforming conventional loans. We're going to go into our FHA then next, and then our expanded guidelines non-QM programs, where we have over 5,000 other loan programs beyond these programs you see here. VA is only for our eligible vets, so we appreciate your service and would love to quote you, but since not everybody's an eligible veteran, we won't do that live. And same with USDA, since those are only for properties in an eligible USDA eligible area, a rural area. We won't do that live, but if you are shopping for one of those eligible properties, please let us know and we'll quote that up for you. So our first example here will be our conforming conventional rates. We're going to do a purchase, 30-year fixed standard loan scenario, primary home, single family, one unit, state of Florida, county Miami-Dade. That's where our office is based. And we're going to do an estimated FICO score of 760 for all our estimates today, and an estimated debt to income ratio of 40 for all our estimates today. So let's click show rates and see what we're looking at this morning before the announcement. So as expected, the rates have gone up a tad since yesterday, since there is this big bit of news. Hopefully it goes down a little bit in the afternoon. Right now, we are at 6.75 rate for one discount point in cost for a final APR of 6.926. So remember yesterday, we were a little bit lower. Obviously, these announcements and news affect the rates for the conforming and FHA programs pretty much instantly, right? The markets react pretty much instantly. We'll go into our non-QM programs, which react a little bit slower, a little more stable there. But this has gone up a tad. I would be very interested to see what happens in the afternoon. But let's check out our next example here. We'll pull up the same exact scenario, ADLTV here, and we're going to click on FHA to check out our FHA pricing. Everything else will stay exactly the same as our previous scenario, so we can compare apples to apples for the same loan. So here the best option the computer found was 5.875 rate for FHA. I believe that's about the same as yesterday. And one discount point in cost in this scenario for a final APR of 6.477. So notice the APR is where we compare apples to apples. This FHA in this scenario is actually a little bit cheaper for our borrower. Not often that happens, but since we have some new announcements that the HUD has made on the mortgage insurance that is required for FHA, it does make this a very good option. Please get with our team if you'd like to compare the FHA options to the conventional options. Now, if for any reason our borrowers do not qualify for a conforming or conventional loan or a FHA loan, many other lenders or banks do not have other options. Fortunately, here at the Mortgage Calculator, we have over 5,000 other loan programs beyond FHA and conventional for our borrowers under expanded guidelines, aka non-QM. So we'll set up our final scenario exactly the same so we can compare the three different options. And we will go to everything set the same, but you'll notice a new option has popped up, income verification. This is where we're able to use our alternative income documentation for this loan. So full doc would mean 2 years tax returns. That's what conventional and FHA require. So usually we're going to choose a non-QM program to not have to use full doc. So 1 year alt doc, 2 year alt doc, very common. Asset related, that's what Jose is going to talk about later today. All of our programs under this option, which actually don't require income, it's just based on assets and using those as potential income. We have business bank statement programs, very popular. Investor DSCRs we'll do in a minute. But for our demo today, our most popular non-QM program is going to be our 12-month personal bank statement program for our self-employed borrowers. So this will typically allow our self-employed borrowers that file 2 years of tax returns. A lot of times they have various write-offs and other things that maybe make them a little bit challenged to qualify at all or qualify for as much home as they want. So in this case, we're going to use 12 months of bank statements, no tax returns, to determine a debt to income ratio based on their actual cash situation. Many of our self-employed borrowers qualify for double, triple the amount of payment expense when they're able to use their bank statements as income. So this is a very popular program, especially for our self-employed borrowers. So let's check out our non-QM rates this morning. That one's obviously screwed up. That's not going to work. Some reason the computer had a mistake there. But this option will be the best real option, 7.375 rate for one discount point in cost for a final APR of 7.422. So obviously non-QM programs we're using alternative income are going to be a little bit higher on the rate, but right now it's very comparable. So remember our conforming conventional options were I think it was 6.8 something, very high sixes. This non-QM option is just a little bit higher, just in the low sevens on the APR when we compare apples to apples. So we love to offer these programs to all of our borrowers so they can compare side by side. Very comparable right now. It's not so often that conforming FHA and non-QM are all right very close to each other because of the way the markets are today. So definitely recommend everybody check out some of these non-QM options. It may expand your options too when you're shopping for a home. Notice there's dozens of different versions of these programs that use bank statements. So please get with our team. There's just a ton of different options. Some of these may allow things, might be very high rates, but they might allow things like a recent foreclosure or recent bankruptcy. So when we get under these non-QM programs, not only do we have the ability to use bank statements, but a lot of other guidelines we can get around that are typically going to cause an issue. So please get with our team to navigate through all of those. Now, before we pass it over to Jose, let's go into our final live rates demos. We always want to pull up our investment property rates. We love to work with investors, whether you're a first-time investor or you have 100 rental properties. We love to have options. So we're going to quickly go through the same scenario, ADLTV, and we're going to compare our two options for investment. We have our conforming conventional options for our borrowers that qualify full doc, and then we have all of our amazing non-QM options under expanded guidelines. So we'll compare those two. First, we'll check out our conforming options. Everything will stay the same as our other demo scenario, but now we're doing investment property. So you see here, rates a little bit higher than they were yesterday. Investment properties, they do have an extra cost. So you see the computer was unable to find a 1 discount point in cost option. So the best option the computer found, 6.875 rate for 3.625 discount point cost for a final APR of 7.139. So there are some additional costs and fees that have come under these conforming programs for investment properties. So many times our investors are asking to have other options just to compare. And that's, again, where we love to bring up our non-QM options. So great rates, great options for our borrowers that do qualify full doc, a lot of discount points. So I definitely recommend our borrowers looking at investment properties compare these conforming options with their non-QM options. So let's go into that next. For the final demo here, we'll set investment property, we'll set ADLTV, and we'll go to expanded guidelines, aka non-QM. And now we'll notice we have two new options. So we have our income verification option we've already been through. In this case, for investment properties, our most popular income verification is DSCR, debt service coverage ratio. And that is because it doesn't actually require any income or employment from the borrower. We're simply going to use the estimated rental income from the property to determine if the property rents can cover the mortgage expenses for this mortgage. Typically, if the rents can cover the expenses, that's a ratio of over 1. And we have hundreds of loan programs for DSCR ratios over 1. We also have loan programs for ratios under 1, properties that don't quite cash flow. So even if it doesn't quite cash flow, we still have options for that. Now, for our standard scenario, we're always going to have a prepayment penalty on an investment property under non-QM. So most of our options are going to be under 3 years. We can choose 0 prepayment. That's always an option. It's going to cost a little bit more, and it's going to limit our loan programs. So we always want to do 3 years for more of a standard option. We could even do 5 years if we want to save a little bit more money. But again, it limits our loan programs a little bit. So we'll do 3 years for our standard scenario. And let's check out our DSCR rates this morning. So obviously the APR is going to be a little bit higher, but remember, we're looking for options to save our borrowers, our investors, money out of pocket, right? So even though this is a little bit higher rate, 8.125, the discount points are much more reasonable, right? Our borrowers can save, $10,000 in this scenario, cash out of their pocket to deploy in other investments. So in this case, even though the rents or the rates are a little bit higher, 8.125 for 0.975 in discount points, final APR of 8.171. Remember, the conventional investment properties were 7 point, I think it was 2 something. So low 7s. Now we're in the low 8s. So very comparable side by side. Make sure you guys always compare these options. These are great for our investors because you can also start multiple loans. Doesn't require income, employment from the borrower. So a lot of times our investors that have multiple properties will cash out a couple properties in order to purchase a couple properties, and we can start multiple loans at the same time, which is a very big benefit for our investors. Now, if you scroll down here, we have a bunch of different options with different DSCR ratios that are required, different prepayment penalty options, like fixed prepayment penalties. So please get with our team. They can navigate the hundreds of options we have here for the DSCR to find which best fits your scenario. Some of these options at the higher rates may allow things like short-term rental income and things like that. So please get with our team. We would love to navigate you through all these different options and find the one that fits best. So now let me switch my screen and we'll get into our topic for today. Give me 1 second. And today, our deep dive topic is going to be on asset utilization loans. So, you guys saw on my demo, there is a option in the drop down for assets. It seems pretty simple, just one drop down option, but there's a lot that goes into that for our team that's here watching. Make sure that you listen to Jose here. It's just one option, but if you look into this program, it just opens up a whole avenue of different things we can do for our borrowers. It's very interesting. So, Jose Gonzalez, our sales manager, going to take over here and talk about asset utilization loans. And I guess give us a quick intro, Jose, and then we'll go into some of your live examples here. You ready?
Yes, sir. Thank you, everybody. Thank you for joining us this morning for Daily Mortgage Rates Live with the Mortgage Calculator. Jose Gonzalez here, sales manager. Asset utilization is another of those mind blower topics because we are essentially qualifying the borrower on the liquid assets that they have. Liquid assets can be a number of things from the very liquid checking accounts that basically have cash to the a little bit less liquid retirement accounts like 401k and IRA accounts. Those are applicable to be used for asset depletion and asset utilization. What is not applicable to use is, for example, artwork, gold sitting in a vault, fancy paid off cars, other properties, for example. Those are not really liquid assets for the purpose of these programs. These programs are very specific with how they calculate the income. Now, I can't generalize all asset utilization programs because there are differences. Some may use 60 months, some may use 360 months, some may use 240 months, and they're going to use different percentages of the amount. So I do refer you all to the specific guidelines of the program that you are selecting. Now, asset depletion is not employment based. It's not property type based. It's not borrower type based. It's available for all property types, 1 to 4 units, and it is available for investment properties, primary homes, second homes. Is no limitation on borrower type or property type as long as it falls within the normal eligible properties that we all look for. The only issue is just the assets and are they usable. So, in the first example that I have here, it is a 90% loan to value primary purchase using asset utilization, right? This is the highest loan to value that is available for this product type and basically is the highest loan to value available for any non QM full doc loan type. Asset utilization does fall under income, some type of income verification. you know as you note from the previous episodes, we had our traditional full doc that uses tax returns, pay stubs, w2s, whatever may be applicable in that realm for the borrower. Then we have our bank statement options, we have our profit and loss option, and now we have our asset utilization or asset depletion option. Those are all different forms of full documentation. So it would be a trade loan. For those of you that were wondering, is this a trade loan? So in this example here, we're looking at 9.875 being the lowest cost option, just under 1 point cost, and 9% being the lowest rate option, being at just about 2.75 points. This is 10% down, or 90% loan to value, primary occupancy. So that was our 90% option, which is our highest LTV option. Now we have our 85% option, and you will note rates get a little bit better. I'm going to bring the other one side here a minute so you could see 9.875 at $10,000 there. 9% was still costing 16,000, whereas here 9% is costing 39.84 and 9.375 is at par, with the lowest rate option being an amazing 8.125. So you will see how if we drop just 5% LTV, we do get a much more favorable rate. So these are all things to be taken into consideration when we are providing options to our borrowers. We have to ensure that we provide them all these different configurations, because the borrower may decide that for an extra 5% down, it's really worth it for them to benefit from the lower rates. Now, our lowest loan to value investment option is 80%. We do not have an 85% option in asset utilization, as it is seen as a little bit riskier than a profit and loss option or a bank statement option, because those assets could get depleted a lot quicker if the borrower decides after closing to go on a spending spree. So there's a little bit less control over the parameters really being considered for the income. But you will note great options here at an 80% for this investment property. 8.125 is the par rate, and you can buy it down all the way to 7.125 at a cost of 3 points. So these are amazing rates. So we will now look at our asset utilization refinance. Now, for an investment property, 75% is the highest loan to value that we have available for the asset utilization cash out of an investment properties. And the examples I've been showing so far, excuse me, are for a 1-unit property, 1-unit single family detached home. So in our 75% LTV cash out option, you will note 8.75% lowest cost option, and 7.875 is our lowest rate option. 75% loan to value investment property purchase, investment property refinance, cash out refinance. And now our primary cash out refinance maximum loan to value is 80%. So you will note again, pretty good rates here for a cash out refi at maximum loan to value. 9.25% is at par, and you can buy it down to all the way down to 80% at a cost of about 2.75 points. But now I got some additional tidbits for you. We love those 4 units. So I always like to throw the example down with a 4-unit property so we can really maximize the benefit here. So you will know great rates here. Now, this is 80% LTV 4-unit purchase using asset utilization. This normally would be a dream for most people, but at the mortgage calculator, this is a reality. Because here, amazing rates now, 8.375% is at par with the lowest rate possible, 7.25% at 3 points. Those are conventional rates for a 4-unit asset utilization. So in other words, conventional rates that would not be possible, conventional rates for a 1-unit, here we're seeing them for a 4-unit using asset utilization. And here is our 4-unit investment cash out refi, maximum loan to value, 70% loan to value, and 8.5% is at par. And you can buy it down again to conventional loan rates here, 7.5% at a cost of about 3.125 points. So mind you, this is the ultimate house hack 4-unit cash out refi asset utilization. I mean, I'm running out of verbs here, out of description for this amazing scenario that we have here, we never cease to amaze ourselves at all the solutions we have at the Mortgage Calculator. So really looking forward to helping you all structure your asset depletion or asset utilization, because the loan goes by both terminology.
Hey, so Jose, that was awesome. So basically a real life scenario, right? If I'm a loan officer and I have a client, let's say that they're retired, they don't have any, necessarily income, but they have a large amount, they have a large retirement or a large amount of cash. What you're saying is they can literally qualify and they're going to extrapolate income from that. They could have no income and do it based just off of their
Correct.
assets.
Now, you state a very interesting question there. I was actually going to touch on it, um, because, yes, to answer your direct question, yes, if you have a retired individual without any real substantial income, but they have, let's say, $2 million in a 401k or an IRA, yes, you can definitely use that. There's an additional trick here is for Freddie Mac loans. They actually have, if a borrower is 62 or older. Now, this is not a non-QM asset depletion or asset utilization, but they do let you add income with asset utilization on those loans, as long as the borrower is 62 or older and has some amount of income, like a retirement pension or something, or even if they have a job but they're 62 or older, you can use asset utilization to add income. Not as the sole income, like in this example here, this is the sole income, but you can use it to add income, which is a very interesting hack.
Yeah, definitely a good hack there for conventional loans. You can add assets as income as well. Jose, there for an example though, just so everybody knows. So for the $2 million in the bank, for the typical scenario, how are you going to turn that into income? Can you just take that $2 million and turn it into income using the most common method
Well,
for asset utilization?
they're going, we would have to refer to the formulas of the individual investors, but they're usually going to divide it by a number of months. They could divide it by either 240 months, or they could divide it by 360 months. They're just going to give you a certain percentage of the whole, and then divide that by the number of months for that formula, and that's going to arrive at a monthly income figure, and that is the income that they're going to apply to the loan for DTI calculations.
So in this example, I'm going to go 2 million. If it's in retirement, they'll usually give a haircut of 75%, right? So let's take that 2 million times 0.75. So we're going to have 1.5 million usable for our income calculation. Now, some of them divide by 240, as Jose explained, 240 months, right? That equals 20 years, right? So they're going to do a 20-year. Some do a 5-year, 60 months, right? They divide it by 60 for a 5-year. Some do a 30-year and just take it out over the whole loan, and they say, hey, we want to figure out how much money you'll have for the whole life of the loan. That's 360, right? So it depends on the guidelines. But let's take a nice even one there, Jose, the middle ground of let's do 240. So let's divide that by 240, the 1.5 million. And now we have $6,250 of monthly usable income for this borrower in that case, right? So that's a great example of exactly how much income, 2 million retirement would get that borrower in that case. Hopefully, if they need more, we might have to choose a different program that uses the 60 method. So if we take that 1.5 million of usable income and divide it by 60 with the 60 method program, 25,000 a month. Big difference, right? So some of those programs we saw that might have been the higher rates might be because they use an alternative calculation. So you might not be able to get what Jose showed you there using the more aggressive calculation, but we love to do these scenarios, right? So please get with our team. They'll figure out which one does which math, and we can find out which flavor of this asset program will work best, because a lot of different flavors and ways to do it, but there's always a solution. You see, that same borrower has 6,250 in income at one program, 25,000 in another program. Big difference there. So we have a solution for every borrower there within that. You're muted there.
Yeah,
Jose,
I
you're
was
muted.
looking up while you were describing that. I was looking up one of the options that I quoted, the last one, which was for the 4 unit. Um, and they divide the allowable assets. So it says most recent 6 month asset documentation verified by cash, 100%. Stocks, bonds, or mutual funds, 90%. IRAs, 401ks, retirement accounts, 80%.
Mm.
That's pretty good. And then they divide that by 84 months.
That's a see, everybody's got their own flavor, right? 84, that's a
Yeah.
unique one, but it's right in between there.
So that one would get a lot of income there because they're going 100, 90, and 80. So they've been giving you 80% of the retirement accounts. It's very good.
So I have a client. They have $2 million in the bank or in their retirement. They take that haircut. We divide it by whatever you're saying, Nick. So I literally just say, here's my down payment and here's my money in the bank. Proof of the money in the bank. I mean, that's as
And you
simple as
got a
this
loan,
is.
yeah. No employment verification and pay stub verification, right? We're just gonna take that asset. So we just got to have, as Jose mentioned, 6 months of it is what he just read off there, right? So we need the last 6 months. Make sure the money's really there. So it's a little bit stricter on the seasoning, right? So sourcing and seasoning, we need to make sure that that's been there for a while. You can't just be popping money out. So a lot of times our crypto clients, for me, want to use this program, but they are ineligible because you can't crypto money's in a crypto account. It needs to be in a real, bank account as cash for 6 months in this case. So my crypto clients often don't want to sit their crypto in a cash, US dollar account for that. So it's for a specific person. The retirement's a perfect example, right? Nobody's touching their retirement, right, Jose? So retirement's easy to use, but be careful with those cash accounts because people move cash a lot. And if you don't have 6 months proof of that cash has been there for 6 months, that could be a challenge. But some programs may only require 3. Some programs only may require 2, right? So it just all depends.
For this example that you were asking about, Kyle, $2 million, if we were using the last option that I provided and the one that I just gave the formula to now, it would be $19,047.62 would be the monthly income for that borrower.
And then we would offset that on the DTI to a 50 DTI. Typically, is the non-QM DTI that we're looking for. Stay under 50, which would be pretty easy with 19,000 in income, right? That's a lot of juice to use there.
Yeah, absolutely.
And on a 4-unit, remember, they're still going to get 75% of the income of the properties that are leased, right? Of the estimated rental income if they're unleased or if they are leased, right? So if that property is leased and they're buying 4 units, they get rental income from the property and their asset depletion income. So great example there too.
That's amazing. All right. Well, appreciate it, Jose. That was great. If you want more information on these programs, you can go ahead and follow up with us at themortgagecalculator.com. We can pair you with one of our loan officers. We have 350 loan officers all across the country, licensed in 22 different states for, conventional, primary, and all that kind of stuff. And then also we do DSCR business purpose, like Nick was showing earlier, in most states. So we can pair you with one of our loan officers. As you know, we do these non-QM loans like we talked about, and our loan officers can help consult you through the process. So visit us at themortgagecalculator.com. We can pair you up with somebody on our team that can help you out. And you can also email us info@themortgagecalculator.com. We do this show every weekday at 11 a.m. Eastern, so you can see how the rates go up and down. Please tune in tomorrow. I promise you there's going to be some different rates going on, even just later today. So we hope to see everyone tomorrow. Thank you, Nick. Thank you, Jose. And see everybody at 11 a.m. Eastern time tomorrow. Thank you.
Thank you.
Thanks, everybody.